For more than 70 years, the US dollar has been far more than a currency. It has been the foundation of global trade, the preferred safe haven for international investors, and one of Washington's most powerful strategic tools. But the dollar is not facing its greatest challenge because another currency has suddenly replaced it. It is facing a quieter challenge. Around the world, governments are beginning to prepare for a future in which dependence on the dollar is no longer taken for granted. That does not mean the dollar is about to collapse. In the fourth quarter of 2025, the US dollar still represented 56.77% of allocated global foreign exchange reserves. In the same year, the dollar was involved in 89.2% of all foreign exchange transactions recorded by the bank for international settlements. The real story is not the end of dollar dominance, it is the gradual end of unquestioned dollar dependence, and that distinction could reshape global power. For ordinary people, the debate often appears to be about inflation, interest rates, and Federal Reserve policy. Financial markets react to employment reports, bond yields, and central bank speeches, but governments and major financial institutions are watching a much larger question. Does the world still trust American financial leadership as completely as it once did? That question is different from asking whether the dollar is rising or falling in value. A currency's real power is measured by how many countries hold it in their reserves, how much trade is settled in it, and how deeply it is embedded in global financial contracts. The dollar remains the leading currency in all of these areas, but its share has gradually changed over time. According to IMF data, the dollar's share of global reserves has declined from roughly 70% around the beginning of the century to 56.77% in the fourth quarter of 2025. That is not a collapse, but it is a signal. Central banks are gradually diversifying their reserve portfolios. Some are increasing their holdings of euros, gold, renminbi, and other assets. Some governments are exploring local currency settlement for bilateral trade. None of these steps can challenge the dollar on its own, but thousands of small decisions can create a major strategic direction. To understand how the dollar reached the center of the global system, we need to return to 1944. As the Second World War approached its end and much of Europe and Asia had been devastated, the United States emerged with the world's largest economy, unmatched industrial capacity, and enormous gold reserves. That strength gave Washington an opportunity few nations in history had ever possessed. Representatives from dozens of countries gathered at Bretton Woods to design a new international monetary system. Currencies were linked to the US dollar, and the dollar was linked to gold. The arrangement made the dollar more than an American currency. It made the dollar the center of a new global order. In 1971, President Richard Nixon ended the convertibility of the dollar into gold. The Bretton Woods system began to disappear, but the end of gold convertibility did not end the dollar's global role. By then, international trade, banking, and investment had become deeply connected to the American currency. The dollar's strength shifted from gold to institutions of liquidity and trust. Its power was no longer based only on a promise to exchange dollars for gold. It was based on the depth of American financial markets, the stability of its institutions, and the belief that dollar assets would remain accessible and valuable. The dollar also benefited from the growth of international energy markets. So for decades, a large share of global oil trade was priced and settled in dollars. Energy importing countries therefore needed access to dollar reserves. Oil exporting nations often invested their dollar revenues back into American financial markets. This reinforced global demand for the currency. But oil alone did not create dollar dominance. The dollar also depends on the size of the US Treasury market, the strength of American banks, the reach of global payment networks, the openness of capital markets, and the legal credibility of American institutions. This is why replacing the dollar is so difficult. A reserve currency needs more than a large economy. It needs deep capital markets, political credibility, convertibility, financial liquidity, and global trust. China has a massive economy, but its currency still faces capital controls and limited convertibility. The euro is a major international currency, but Europe continues to face challenges involving fiscal coordination and political unity. Gold remains important for central bank reserves, but it cannot provide the same daily liquidity and settlement convenience as the dollar. This is why the world has not found one single replacement for the dollar. Instead, it is developing several partial alternatives. The biggest challenge to the dollar is not coming from one country. It is developing through many gradual changes. China has expanded the use of the renminbi through trade agreements and cross-border payment infrastructure. Russia has worked to reduce its dependence on Western financial systems after facing sanctions. Several emerging economies have discussed local currency settlement and alternative payment mechanisms. These efforts are driven by two major concerns. The first is economic efficiency. If two countries trade with each other regularly, they may want to use their own currencies to reduce exchange costs. The second is geopolitical risk. Financial sanctions have forced many governments to ask how they would continue trading if access to dollar-based payment networks were restricted. This is where financial diversification begins. A country does not necessarily need to oppose the United States. It may simply want more strategic options. That distinction is important. The goal is not always to destroy the dollar system. Sometimes the goal is to avoid being completely vulnerable to it. The dollar also gives the United States a form of geopolitical power that goes far beyond economics. When global transactions pass through American financial institutions, Washington can use sanctions and payment restrictions to influence the behavior of governments, companies, and banks. Access to banking networks, reserve assets, and international payment infrastructure gives the United States a form of power different from traditional military force. Financial pressure can sometimes be cheaper and more effective than direct confrontation, but this creates a strategic paradox. Every major use of financial power can encourage affected countries to build alternative systems. Short-term sanctions may strengthen American leverage. Long-term overuse may encourage governments to reduce their dependence on the dollar. This does not mean sanctions will disappear. It means policymakers must consider both their immediate benefits and their long-term consequences. The United States now faces a difficult balancing act. It must control inflation, maintain economic growth, finance large government borrowing needs, and preserve confidence in Treasury markets. At the same time, it must respond to geopolitical competition and maintain global alliances. These objectives do not always move in the same direction. If inflation remains high for too long, the purchasing power of the dollar can come under pressure. If government borrowing grows too quickly, investors may question long-term debt sustainability. But if monetary policy becomes too restrictive, economic growth and financial stability can also suffer. Dollar leadership therefore depends on much more than interest rate policy. It depends on the credibility of the entire American economy, productivity, technological innovation, energy security, institutional stability, and fiscal discipline all support the dollar's strategic position. And your reserve currency cannot be created by government instructions. It is built through trust, and trust must be continuously renewed. There are several realistic paths for the future. The first is gradual adaptation. In this scenario, the United States strengthens the foundations that made the dollar successful. American financial markets remain deep and open. Institutions retain public and international confidence. Technology and productivity continue to advance. Washington focuses on long-term economic credibility rather than reacting to every short-term challenge. Under this scenario, the dollar remains dominant. Its share of global reserves may decline modestly. Some trade may move into local currencies, but no single competitor replaces it. The second path is accelerated financial competition. In this scenario, countries rapidly expand local currency trade. Regional payment networks become more important. Central banks hold a broader combination of currencies and gold. The dollar remains the leading global currency, but its relative share of transactions and reserves gradually declines. The impact would not appear as a sudden collapse. It would emerge through changing capital flows, higher borrowing costs, and reduced financial influence. The third path is geopolitical fragmentation. Major conflicts, sanctions, or strategic crises could push rival powers to build separate financial networks. One group of countries could remain centered on dollar-based systems, another could strengthen China-led infrastructure. Other nations could create regional arrangements, global trade would become more expensive and more complicated. Companies would have to operate across different payment systems, currencies, and regulations. This would not remain a financial issue. It could affect supply chains, military alliances, and diplomatic decisions. The greatest risk to the dollar is not an overnight collapse. The deeper risk is that the world gradually becomes less dependent on it without finding a full replacement. If central banks diversify their reserves, if more trade is settled in local currencies, and if alternative payment systems expand, American financial leverage could slowly decline. The change may be so gradual that ordinary citizens barely notice it. Governments, however, could see it in reserve data, capital flows, bond markets, and payment statistics. Strategic influence often begins to weaken while a country still appears extremely powerful. That is why early signals matter. The United States still possesses enormous advantages. But assuming those advantages will last automatically would be a bit of a mistake. Washington will need to preserve fiscal credibility, strengthen the Treasury market, use sanctions with strategic restraint, invest in productivity, and maintain confidence in its institutions. It will also need to remain a leader in digital payments, financial technology, and global economic cooperation. The best way to protect the dollar is not simply to defend its international status, it is to maintain an economic and institutional environment in which the rest of the world still finds using the dollar to be in its own interest. The US dollar remains the most influential currency in the global economy. It is supported by the deepest financial markets, the widest payment networks, and the strongest international habits. Its presence in 89.2% of global foreign exchange transactions in 2025 demonstrates the scale of that dominance. But dominance and permanence are not the same thing. No global system remains unchanged forever. The world is not united in an effort to eliminate the dollar, but many countries are trying to make sure they will not depend on the dollar alone. That is the real strategic shift. This is not a story about the collapse of the dollar. It is a story about the gradual decline of unquestioned dollar dominance. The future of American financial power will depend on how quickly the United States understands this changing environment. Will it strengthen its institutions? Will it address its fiscal challenges? Will it maintain the confidence of allies, investors, and trading partners? Or will it continue to assume that the dollar's global role is automatically secure? History shows that great powers do not become weaker only when a rival overtakes them. They can also become weaker when the rest of the world stops believing that their dominance will last forever. The dollar remains at the center of the global financial system, but the world has begun building alternative paths around that center. The most important question of the coming decade will not be whether the dollar disappears. It will be whether America can preserve its leadership as global financial power becomes more distributed. Because in geopolitics, the greatest advantage is not simply possessing power, it is recognizing that the rules are changing before everyone else does.